Sleep 2 Business Genius, Business History, Fact Number 7 of 107-minute read. The first investors set sail. Long before Wall Street, before the stock exchange, before venture capital, a group of merchants standing on a Mediterranean quayside made a deal. They would pool their money, load a ship, and share whatever the sea returned. It was the world's first shared investment, and it changed commerce forever. By Sleep to Business Genius Ancient Commerce Mediterranean Sea c. 400 BC 200 AD. A Greek merchant vessel sets out across the Mediterranean at dawn, its hold loaded with amphorae of wine and oil, the cargo of a shared venture funded by investors who would never leave the shore. Let your breath slow. Let the world go quiet. And listen, somewhere beneath the silence, for the sound of waves. It is before dawn on the harbor at Athens, or Corinth, or Rhodes, one of the great Greek trading ports of the ancient Mediterranean. The air smells of salt and tar and cedarwood. A merchant ship sits low in the water, her hold loaded with amphorae of wine and oil, bales of cloth, ingots of copper, perhaps a consignment of fine Attic pottery destined for markets in Egypt or Sicily or the Black Sea coast. On the quayside, 3 men are talking quietly. One is the ship's captain, who will sail the voyage. The other 2 will never leave the harbor. They are investors. And the agreement they are making, by handshake, by oath, soon to be written on a wax tablet, is one of the most consequential financial innovations in history. They will fund the voyage together. They will share the risk. And if the ship returns safely, they will divide the profit. It sounds simple. It was revolutionary. For the first time, wealth that sat idle on shore could travel the seas, multiply in distant markets, and return transformed, without its owner ever leaving home. The bottomry loan. Greece and Rome c. 400 BC onwards are the ancient world's first risk-sharing financial instrument. The financial instrument that made this possible had a name, the bottomry loan, known in Greek as the nautican danian, or sea loan. Its logic was elegant. A merchant or group of investors would lend money to a ship's captain to fund a voyage. If the ship arrived safely, the captain repaid the loan with interest, often 20 to 30% for a single voyage, reflecting the genuine peril of the sea. But if the ship was lost to storm or piracy, the loan was cancelled entirely. The investors bore the loss. The captain owed nothing. This was not charity. It was the ancient world's first systematic mechanism for pricing and distributing risk. The high interest rate compensated investors for the real possibility of total loss. The cancellation clause gave ship captains the freedom to take on voyages that would otherwise be too dangerous to attempt with borrowed money. And the ability to pool contributions from multiple investors meant that no single person had to stake everything on a single ship. You could spread your exposure across several voyages, reducing the chance that any one disaster would ruin you. The evidence. The Athenian orator Demosthenes preserved several bottomry loan contracts from the 4th century BC in his legal speeches, real documents from real disputes, detailing exact loan terms, interest rates, cargo lists, and agreed routes. They read remarkably like modern loan agreements. One contract for a voyage from Athens to the Black Sea and back specifies the cargo, the route, the interest rate, 22.5%, and the conditions under which the loan would be forgiven if the ship was lost. From loan to partnership. The bottomry loan was powerful, but it was still essentially a creditor-debtor relationship. The lender provided money and expected repayment with interest. The captain provided labor, skill, and seamanship, and bore the operational risks of the voyage. The 2 parties were connected by debt, not by genuine shared ownership. As Greek and then Roman maritime commerce grew more sophisticated, a more intimate form of shared investment began to emerge, the true commercial partnership, in which investors contributed capital and shared both the profits and the losses of a venture as genuine co-owners. Roman law formalized this as the societas, a legal structure in which partners pooled resources, shared management, and divided returns according to their agreed shares. For maritime trade this was transformative. A wealthy Roman businessman might invest in shares of several different trading voyages simultaneously, holding a quarter share here, a fifth share there, spreading his capital across a portfolio of ventures the way a modern investor spreads money across a portfolio of stocks. The vocabulary is almost identical because the underlying idea is The Roman merchant investor looking at a fleet of ships in the harbor of Ostia was doing precisely what a modern fund manager does looking at a screen of equities, allocating capital across a range of opportunities, balancing expected return against accepted risk. The idea that never sank. The Western Roman Empire collapsed in 476 AD. Its merchant fleets shrank. Its trade networks contracted. But the financial principles that Greek and Roman merchants had developed did not disappear with the empire that had given them their most sophisticated expression. Medieval Italian merchants, trading across the same Mediterranean waters, rediscovered and refined the same instruments. The Commenda contract of medieval Venice and Genoa, in which a stay-at-home investor funded a traveling merchant in exchange for a share of the profits, was a direct heir of the ancient sea loan. The joint stock companies of the 17th century, including the Dutch and English East India Companies, took the logic further still, selling shares to thousands of investors at once, spreading maritime risk so widely that no single storm could threaten the capital of any individual shareholder. From quayside to stock exchange. The essential structure of the bottomry loan, pooled capital, shared risk, agreed return, limited liability for loss, is the direct ancestor of the modern share. When a company lists on a stock exchange today and sells equity to thousands of investors, it is enacting the same logic those Athenian merchants worked out on a harbor quayside 2,400 years ago. The ship has become a corporation. The sea voyage has become a business plan. But the deal is the same. What they understood about risk. The merchants of ancient Greece and Rome understood something that took financial theory millennia to formalize. That risk is not simply a danger to be avoided, but a variable to be priced, distributed, and managed. The bottomry loan did not eliminate the risk of a ship sinking. It allocated that risk to the people best placed to bear it, the wealthy investors on shore who could absorb a loss, and freed the people best placed to manage the voyage to focus on seamanship rather than financial ruin. That insight, that the right response to risk is not paralysis but intelligent distribution, is the foundation of insurance, of investment banking, of every financial market ever created. It was first articulated not in a lecture hall or a trading floor, but on the salt-stained quaysides of the ancient Mediterranean, by merchants who needed a better way to send a ship to sea. The first investors never left the harbor. But their idea sailed everywhere. Tags: Sea Loan, Bottomry, Ancient Greece, Ancient Rome, History of Investment, Shared Risk, a Maritime Trade, Business History, Sleep Learning, Economic History. Sleep to Business Genius weaves 100 fascinating business history facts into soothing, story-driven narratives. This is fact number 7 of 100. Part of 100 Facts About Business to Fall Asleep To, available as a full narrated video on YouTube.